Below is the complete English translation of the text, rendered in a similar style and as fully as possible. Offense and defense in soccer and investing. In soccer, switching between an attacking and a defensive formation based on the unfolding situation on the pitch is one of the most critical skills for the world's top teams. A top continental club knows when to launch a lightning-fast, aggressive attack to score and when to anchor itself with an impenetrable defense to protect its advantage. A team that excels in only one of these two areas will never reach the highest level. To become the new champion of the Champions League, a team must master both the art of attacking and that of defending. In investing, you are the captain steering your own team. A skillful investor knows when to put the portfolio into an offensive mode and when to switch to a defensive stance. Attacking at the wrong time can lead to catastrophic losses in an instant, while a constant defensive approach may mean missing out on fantastic profit opportunities. If you are only adept at attacking, you might enjoy impressive short-term gains, but eventually risk losing everything over the long term. Conversely, if you focus solely on defense, your returns will hardly be able to outperform the overall market benchmark. A smart investor is one who can accurately sense what is happening in the market and adjust the balance between offense and defense in the portfolio accordingly. In other words, it is also essential to weigh the two inseparable risks in investing: the risk of losing capital and the risk of missing out on potential gains. When a soccer team goes on the attack, it raises its formation and leaves a significant gap behind a considerable risk if the opposition can launch a rapid counterattack. Similarly, increasing the aggressive position in your portfolio comes with a proportional rise in the risk of losses. This is particularly dangerous during uncertain times when most investors react emotionally and follow the herd. However, if you concentrate solely on defense, it becomes much harder to score gains, just as forwards in a soccer team must seize the few scoring opportunities they get. A portfolio that is overly defensive means the investor has undoubtedly missed many excellent profit opportunities from the past and will have difficulty outperforming the broader market over time. How market cycles affect your portfolio positioning? The market always operates according to its own will. Stock price fluctuations depend on numerous variables beyond any investor's control. Most investors form their own expectations about future market prospects based on sound economic reasoning. As noted earlier, another way to think about offense and defense is to balance two risks: the risk of losing capital versus the risk of missing out on opportunities. In a rising market, the risk of losing capital is generally lower than the risk of missing lucrative opportunities, and the reverse is true in a falling market. In other words, the current phase of the market cycle is one of the most important factors in determining the optimal balance between offense and defense in your portfolio. When an investor prioritizes an offensive stance, the goal is to maximize returns. Conversely, an investor who wants to preserve gains or minimize losses will adopt a defensive approach. Common actions associated with these stances include offensive moves, increasing the amount invested in riskier or speculative assets, raising leverage such as using margin, concentrating investments in a few high-risk, high-return stocks rather than diversifying broadly, or chasing stocks that have already surged with the expectation of selling them at even higher prices later. Defensive moves, boosting cash holdings, focusing on safe stocks during market crises, reducing margin exposure, and diversifying the portfolio conservatively. Experienced market participants will recognize that these behaviors are closely tied to bull and bear markets. In times of exuberance, it is common to assume extra risk in order to capture higher returns. During periods of panic, most investors increase cash reserves and avoid entering the market. In practical terms, an investor cannot simultaneously eliminate the risk of losses and the risk of missing opportunities, as the two always move in tandem. If you decide to prioritize an offensive stance, you must accept that the risk of capital loss will also increase. If you choose defense, you implicitly accept that you might forego some attractive profit opportunities. Because it is impossible to eradicate both risks at once, the smartest investors decide on the relative priority of offense versus defense based on current market conditions. Predicting the market is extremely challenging, if not nearly impossible, but what separates seasoned professionals from amateurs is their ability to make more accurate probability estimates about future market trends. When experienced investors believe that the market is entering a long-term uptrend, they are willing to shift their portfolio into an offensive position to maximize gains. At that point, the risk of missing out on opportunities outweighs the risk of capital loss. The reverse holds true in a downtrend. Yet, investors must also understand that uncertainty is the only certainty in the market. No matter how carefully you plan, there is always a chance that the decision to favor offense or defense may come with a heavy price if the market moves contrary to expectations. For example, increasing leverage or concentrating in high-risk, high-return speculative stocks just as the market is about to plunge can lead to disastrous outcomes, potentially even a margin call that wipes out your account. Likewise, a portfolio that is overly defensive during a period when the market is on a wild rally will only achieve very modest returns compared to those who capture the uptrend. And naturally, that can lead to feelings of regret and envy. Determining the right moment to switch between offense and defense is one of the most vital skills an investor can master. Experience in the market will help you identify reliable signals that indicate the current phase of the market cycle. As legendary investor Warren Buffett famously advised, "Be greedy when others are fearful, and be fearful when others are greedy." Although this saying has become almost a cliché in the investment community, one must honestly recognize that when the market is caught up in irrational exuberance, especially when speculative stocks are wildly overvalued, it is a clear signal that a severe correction may be imminent, making it the ideal time for a smart investor to adopt a defensive stance to protect. You may make many wise decisions in investing, but a single foolish mistake, such as attacking right when the market is about to correct sharply, can transform everything into a disaster in an instant. No amount of subsequent good decision-making can rescue a portfolio that was caught in an overly aggressive stance during a market storm. Conversely, being overly cautious during a long-term uptrend may yield only meager returns compared to the potentially higher gains you could have achieved. While you might feel secure investing safely, the truth is that your results could be much better if you had balanced both approaches correctly. In practice, smart investors must continuously recalibrate the balance between offense and defense to align with evolving market conditions. The behavior of other investors and the overall environment shaped by the current phase of the market cycle provide essential clues for making these adjustments. When the market becomes increasingly euphoric, more investors are willing to take on additional risk to chase higher returns, and stock prices soar far above their intrinsic values. At that point, risk is downplayed because profit is all that matters. However, this also signals that the market is growing increasingly dangerous, with the likelihood of a bubble bursting on the rise. It is precisely then that a prudent investor should shift to a defensive stance to safeguard gains. In such conditions, the risk of losses outweighs the risk of missing opportunities, so protecting your portfolio becomes paramount, requiring a rebalancing towards safer stocks that can better withstand a downturn. On the other hand, when the market is trading at reasonable levels, with most investors prioritizing safety, stocks priced at a discount relative to their intrinsic value, and a lack of irrational surges in speculative penny stocks, the risk is lower. In a low-risk market, you should be more aggressive in your portfolio. Here, the risk of missing out on gains far exceeds the risk of capital loss, and maximizing returns by concentrating on leading, albeit riskier, stocks becomes the rational choice. However, this does not mean that you can entirely neglect defensive measures. Always remember that without rigorous risk management, the market will inevitably knock you out of the game. Balancing offense and defense, the art of portfolio rotation. The ability to adjust the balance between offense and defense continuously is crucial for a successful investor. This skill requires a clear, objective view of real-time market conditions, a perspective that is entirely detached from the emotional noise of the crowd, allowing you to assess the risk-reward profile of various investments independently. You will never achieve long-term success if you simply follow the murmurs of the market. To conclude, I'd like to borrow and slightly modify a famous saying from Warren Buffett to capture the essence of this section. Attack decisively when the market is fearful, and defend firmly when the market is recklessly aggressive.